Welcome to our podcast today about the topic Pillar 2 or the global minimum taxation. My name is Ines Pausch. I'm a tax partner with Baker Tilly Germany, domiciled in the Munich office. With me by my side today is Chris Denning.
Thanks, Ines. Hi, guys. My name's Chris Denning, and I'm an international tax partner at MHA McIntyre Hudson, which is the UK member firm of Baker Tilly International.
Thanks, Chris. Well, this podcast is the first one of a serial with the intention to inform you step by step about the content of the Pillar 2 rules, the global minimum taxation. Now, we want to cover the timeline, the content, and especially the practical issues around Pillar 2. Therefore, we are more than happy to receive any questions from your side to be covered in one of our next podcasts. However, today we want to concentrate on the basic toolbox of Pillar 2, mainly the timeline and the main content of Pillar 2, starting with the timeline that is quite tight. The OECD published in December 2021 the model rules about Pillar 2. As these rules are quite complicated, the OECD published as well additional commentary to assist in understanding how the rules shall apply from a practical point of view, together with a kind of fact sheet where the key tax provisions of the Pillar 2 rules are explained. Additionally, and shortly afterwards, the EU Commission published their draft directive that will be the basis for the implementation in the European countries. The year 2022 will therefore be a very crucial year with respect to timing, because the implementation has to take place on a global level in the respective jurisdictions, and the multinationals, the tax advisors, have to get familiar with these new rules and also the practical issues, the implementation of the necessary processes, the training of the staff, and all these organizational issues have to be covered in 2022 to be able to comply with the administrative burden of these new rules. What are the main elements of Pillar 2? As already announced in several publications of the OECD, the Pillar 2 rules will be applicable for multinationals with a consolidated revenue of 750 million euros and more. You know this threshold already from the country by country reporting. The aim of the Pillar 2 rules is to achieve a minimum taxation of at least 15% per constituent entity. This aim shall be achieved mainly by 4 elements: the so-called income inclusion rule, the under-taxed payments rule, the switchover clause, and the subject to tax clause. The primary measure is the so-called income inclusion rule that is aiming at the parent company and the parent company's tax income. In principle, the aim is to assess a top-up tax if the minimum tax rate of 15% is not achieved. The second element, or more kind of backstop measure, is the under-taxed payment rule. The under-taxed payment rule, in contrary, is not looking at the parent company, but is looking at the different group companies that are domiciled in low tax jurisdictions, and at the payments that are made to those entities that could lead to a partial or complete deny of a deduction of those expenses to achieve by this way a minimum taxation of 15%. The third element is the switch over clause. The switch over clause includes in principle the abolishment of the exemption method for permanent establishments that are domiciled in low tax jurisdictions. And last but not least, we have the subject to tax rule that would in principle allow certain countries and jurisdictions to assess higher withholding taxes in case or with respect to payments made to group companies that are domiciled in low tax jurisdictions. These four elements form the basic toolbox of the Pillar 2 rules. As always in tax law, there are, of course, a huge number of simplifications, exceptions, carve-outs that we will cover in a separate podcast. However, to give you a short example, the international shipping industry, for instance, is excluded from the application of the Pillar 2 rules, mainly due to the fact that in most jurisdictions, a lot of special local tonnage tax regimes exist that cover already this industry, and therefore it was decided that the international shipping industry is not in the scope of Pillar 2. However, the next steps are then the concrete calculation, and my colleague Chris had a closer look at these measures. Over to you, Chris.
Thanks, Ines, and thanks for that introduction. So I think it's fair to say, I think as Ines has alluded to, I think the model rules are complicated, and those rules then need to be laid over existing domestic legislation, which many jurisdictions in itself is also complicated. So I think we're heading for some interesting times in terms of working our way through the implications of what's being proposed here. Like everything in tax, there's lots of acronyms, and there's no exception as far as these rules are concerned. So in broad terms, the OECD have described these rules as GloBE-Rules, and GloBE itself is an acronym for global anti-base erosion. But we talk in context of GloBE income being the income that's going to be adjusted here under these particular rules. So what does the model actually to talk about? Well, it actually goes through and details a number of steps which multinationals will need to go through to determine whether or not they need to make an adjustment under the rules. And these steps, and this is already referred to it, that these steps are summarised quite nicely in a 6-page document describing the key operating provisions, which I'd recommend everyone has a look at as a first port of call to gain a broad understanding of what we're talking about. But essentially, there are 5 steps that entities need to go through. So step 1 is to determine the constituent entities within the scope of the rules within a multinational group. Now that sort of implies that you sort of choose and determine which entities fall within scope, but in reality, the constituent entity is every entity within a multinational group in every jurisdiction. I mean, Ines is referred to exceptions and carve-outs, which we'll come on to in later podcasts, but at the moment, these rules will apply to every entity in every jurisdiction, including jurisdictions where the statutory rate on the face of it is higher than 15%. You would still need to run through the calculations. So that's step 1. Step 2 is then to identify the GloBE income, which is the income that will be subject to adjustment in each constituent entity. And again, there's some detailed guidance as to what as to how you determine GloBE income. The start point is to look at the financial accounts, profit, and then there's a number of sort of predetermined adjustments that you make to get to a net profit or loss figure in each jurisdiction. And again, in their later podcasts, we'll go through each of these steps in more detail to give you a much clearer steer as to what it looks like in practice. So step 3 is then, once you've determined your GloBE income, step 3 is then to understand what the covered taxes are in that particular jurisdiction, which is essentially understanding what taxes have been paid in the jurisdiction in relation to the profits. Now again, there's a number of adjustments in relation to what constitutes covered taxes, and it includes adjustments for deferred tax, etc. But again, there's detailed notes and guidance as to how you determine covered taxes for the purposes of this. So step 4, once you've determined your GloBE income and your covered taxes, is to work out your effective tax rate and your top-up tax. So the effective tax rate is essentially taking your covered taxes over your GloBE income, which will give you a percentage, which you then compare to the minimum tax rate of 15%. And if you're below that, then the difference, so say, for example, your effective tax rate ends up at 10%, you end up with a 5% top-up tax rate. And then step 5 is to apply that top-up tax to the GloBE profits, and then to make an IRR adjustment, which is an income inclusion adjustment in principle in the jurisdiction which has operated the rules. So that sort of takes you through the very broad steps. So I guess in practical terms, how will these rules be implemented? So from a UK perspective, I mean, the UK, I think, has been probably at the forefront of introducing BEPS measures quite quickly after the OECD recommendation. So the UK is already consulting on the implementation of the model rules into the UK legislation. But that in itself, I think, presents, or raises a number of questions. I mean, the UK have been specific about who it will apply to. So the OECD did say that, jurisdictions, if they want to, they can impose these rules for groups with a turnover of less than 750 million euros. The UK have said that we won't do that, so it will only apply to groups with more than 750 million consolidated revenues. It's proposed that the UK implements the rules with effect from 1st of April next year. So it doesn't give us a huge amount of time to actually go through the consultation and introduce the legislation, and for everyone to get their heads around what that actually means in practice. I think from a UK perspective, the UK, I think, sees the IRR, the income inclusion rule, as being the principal measure, and that will apply to UK multinational or UK headquartered multinational groups. The UTPR rules will only apply to UK entities where the headquartered group is outside the UK, but essentially those rules only apply where the headquarter company doesn't or isn't subject to the IIR in its particular territory. But as I say, I think when you think about the number of other measures, for example, the UK legislation has in terms of countering tax avoidance and tax evasion on a cross-border basis, like, we have our CFC rules, we have the corporate interest restriction, we have transfer pricing per se, we have the hybrid mismatch rules, we have the offshore receipt of intangible property rules. All these rules are already there to counter base erosion to all intents and purposes. So, this is going to be an additional bunch of measures over on top of that we need to think about. I guess in practical terms, so certainly the multinationals we've spoken to thus far, I mean, certainly the largest multinationals with in-house tax resource will be modelling the impact of these rules. But most of the, or few of the companies we've spoken to have sort of implied and inferred that they don't think these rules will impact the group's overall effective tax rate. But obviously it will impose a significant administration burden, additional administration burden on them in terms of actually complying with these rules and running the calculations for each jurisdiction subject to the carve-out. So I think we're in for an interesting time over the next couple of years in terms of getting our heads around these rules as they're implemented in each jurisdiction and then actually applying them in practice.
Exactly. This will definitely be a challenge in the future. Looking at Germany, I think important was the point that you mentioned that it might be difficult to align the GloBE-Rules with certain national rules that are already in place. This is definitely a challenge for Germany as well. And also the administrative burden that you mentioned will be something that multinationals have to look at. To put it in a nutshell, the main point is that each constituent part and entity of the group has to do this calculation. And secondly, it is not sufficient to look at the country's tax rate only. It is important to do this calculation to see whether the effective tax rate is below or over the amount of 15%. And beside all other facts, this is definitely an additional administrative burden for all multinationals that are affected by these rules. Therefore, it will definitely be interesting to see how things are developing. And as we mentioned at the beginning, more is soon to come. Thank you very much for listening. Take care and stay safe.
Thanks all.